Thank you very much, and good afternoon. Thank you for coming to this session. It's great to see all the energy and the excitement and all of the new solutions for the big challenges that we're facing. I was invited to speak about accelerating responsible investing, and I feel a little bit like I was asked to bring a match to a bonfire that's already really going really well. But I will try to give you my point of view from having worked in this field the better part of the past decade developing sustainability standards for investors to be able to understand and appreciate and manage these types of ESG issues. And the goal when I founded the Sustainability Accounting Standards Board, was to be able to develop standards industry by industry. And we had to do 80 industries, so no small feat. Industry by industry, because sustainability looks really different in healthcare than tech and comms, than manufacturing or real estate. And that it's sometimes I think back and it's like now people take that for granted. And certainly investors, that's the way that they view the world. But when we started, we didn't know what we would find in terms of which issues were likely to be material. And materiality was the thing, it was like the holy grail that we were searching for at SASB. And the reason that we were so focused on materiality, which is it of interest to an investor? Will it move the needle on a financial decision? That's what materiality really means. The reason we were so fixated on that was so that we could see exactly the kind of effect that's happening today, which is so that mainstream investors would really start paying attention. Because when we started this work, it was really just the purview of ethical investors or socially responsible investors. So everyone was really focused on, well, what if we could get BlackRock to care? What if we could get State Street to care? And so, of course, if you've been seeing the news, just last week, both BlackRock and State Street came out with announcements saying, we are going to put sustainability at the forefront of our agenda. We are finally acknowledging that climate risk is important. And we would like all companies to actually use SASB standards, which is amazing. And the culmination of a lot of really hard work by very, very talented people to make that case for materiality industry by industry and issue by issue. A little bit later in the press release, actually both the head of BlackRock, Larry Fink, and the head of State Street said, and this is really about value and not values. And that's the phrase that should give all of us pause. And really, you should say, well, isn't that success? Isn't that what you were going for, right? Doesn't that really mean that they're just saying they're going to make the business case for this and they're not going to do anything outside of that? Well, 10 years ago, that was enough. But since the time that we started and where we are now, carbon has just continued to increase. We're now beyond making the business case for these issues, and we're actually going to have to make decisions that involve making trade-offs and hard trade-offs. We're really making the case for survival here. So that's why my three things for accelerating responsible investing don't really have anything to do with reporting or disclosure or materiality, because I think we all know that we're in a race against time here. So my three things are to start with investors needing to have more conviction, companies that need to have more resilience, and a market infrastructure that supports those two things. So I'll just talk a little bit about each of those. So what do I mean by investors having more conviction? Well, it's exactly what I was saying about BlackRock and saying, that we're doing it for value and not values. I think that investors are going to need to make the really, really hard choices. And they're going to need to invest in companies that are actually taking action where there isn't necessarily a business case. Witness, for example, you may have just heard Microsoft on the other stage saying, hey, we've made a big announcement. We're going to go carbon neutral by carbon negative by 2030 and carbon clean by 2050. We're going to clean up everything we put out there. Starbucks also made that announcement a couple of weeks ago. IKEA has been operating carbon negative for a while. There isn't necessarily a business case for Microsoft spending $1 billion a year on cleaning up their carbon. But that is what needs to happen, and that is what investors need to support. They have put more than, I want to get the numbers right because I actually ran the numbers, together 70 million metric tons of carbon dioxide into the atmosphere. Over combined 95 years of operation, Starbucks and Microsoft together. That's a lot of carbon that needs to be taken out. Even better, though, as an investor, it's great to support those initiatives, is supporting companies that are operating carbon neutral from the start, that are not putting any carbon into the air. And if you go to carbonneutral.org, for example, climateneutral.org, you will see companies like the shoe company Allbirds, Clean Canteen, Peak Design, and BioLite. These are mostly US companies, but there are some European ones that are saying carbon neutral is the minimum operating standard for 21st century companies. And this is not material. It's not, no one's making them do, there's certainly no regulation in the US that's making them do this. They are just deciding that this is the way we need to operate in the 21st century, and that needs to be supported by investors. There's a company called Stripe, which is a payment platform. It's also a private company right now. They've gone even further, saying that they're going to invest, and they're a small company, $1 million a year in carbon removal technologies. They're not an energy company. So, but they're also investing in they're operating carbon neutral, investing in taking it out of the air. Under BlackRock and State Street's scenario, that would not be considered material. So what's going to happen to those companies when they go into the public markets, right? They're going to be stressed by quarterly earnings and by investor pressure. And if we have to live by the ethos of BlackRock's big announcement, it's about value and not values, those companies won't be able to make those investments, which are the ones that we need. So just to say a little bit about resilient companies. Resilient companies are the ones that are going to be adaptive, that have an adaptive capacity. We are really focused, and have been for the past 10 years. I know it sounds funny coming from me, who's been setting sustainability standards for this kind of data, but what we need to know isn't in the ESG data. We need to understand how companies are going to adapt to the changes that are coming fast and furious, particularly related to climate risk. And this will affect entire industries, entire sectors, and certain companies will be better positioned than others. You're not going to know how adaptive they are just by looking at greenhouse gas emissions data. So the types of things that make a company adaptive are having more diversity, more minds around the table, better decision making, a culture of innovation. These are a culture that really supports investment in its employees and feedback loops among stakeholders. So this is a whole new way of looking at what makes a company great in terms of sustainability. It's their ability to adapt and innovate on these issues over the long term. And you won't find that in the data sets that are out there now. So that's really important. We need resilient companies because we don't know what's coming, and it takes way too long to build standards that codify this information. Take it from me. It's interestingly the opposite of a modern economic theory that you all probably know about called the moat. It was invented by Warren Buffett, who is made a lot of money on it, but it's sort of the it's the 20th century version of what companies do, right? Build your moat, protect your competitive advantage, build barriers, buy up patents and kill them that could be competitive. We need resilient companies that have porous walls, that are innovating, that let information flow, that build alliances instead of walls, and love employees that are engaged, and even employees that are activists. Don't try to gag them. This is what resilient companies are, and those are the kinds of companies as investors that you want to support and look for. My third point that I'll make just really quickly is on market infrastructure. Especially in the capital markets, the public markets. Once companies enter these markets, innovation plummets. In fact, it's known that patents decline by about 40% in the capital markets once they enter, and R&D gets shifted to marketing budgets, and innovation really declines. So at the Long-Term Stock Exchange, which is the newest SEC-approved exchange in the US, meant to be an ecosystem for sustainable companies and sustainable long-term investors, we're supporting companies who are innovating for the long term through principles, policies, listing standards that give those companies that protection and that runway to stave off some of the pressure from the quarterly earnings. So I don't have much time to say more about it, but you can go onto ltse.com and see what the listing standards are, which actually put stakeholders at the center of a company's purpose. It requires them to have a long-term strategy, and requires them also to engage with their long-term stakeholders and shareholders. So I hope you'll check it out. It'll be operational later this year, and we hope to have a really interesting first group of companies that list that are actually resilient companies. We're working with some amazing companies who are innovating in a way and putting these social issues at the core of their purpose, that without a market infrastructure that supports them, they'll get hammered. Their missions will get eroded. Rothy's, for example, in California, makes shoes from 100% recycled plastic bottles. We're working with a company called Molecule that's transforming indoor air quality with innovative technology. A company called Cheyenne Medical in Wisconsin that's decommissioning nuclear submarines to extract the radioisotopes that they're then using for cancer treatment and detection. The technology that they're using is actually fusion and will form the basis for a really long-term clean energy play. There's no way that that company will be able to do what it's doing in a market with a short-term focus. So we're excited to be supporting those kinds of companies and giving them access to the public markets and still enabling them to achieve their mission. So in closing, I just want to say that I really appreciate the opportunity to be here. I actually started my career wearing a moon suit, and I was not an astronaut. I am an engineer, and I was cleaning up hazardous waste sites. And so these issues are really important to me because I don't want to end my career wearing a moon suit because we have too much CO2 in the air. And when I hear things like, it's about value, not values, that sounds exactly to me like what companies used to say when they would dump their hazardous waste in the backyard. So I'm really excited that we have the kind of momentum here and the kind of conviction here to actually invest for impact and not just when there's a really clear business case, because that's what it's going to take. So thank you for your time, and I look forward to the panel, and I'll be around and we can chat afterwards.